Welcome to Engage in Trade, Tariffs, Taxes, and Trade, our global economic outlook for 2025. I'm Susan Spitz, the Manager of International Business here at the World Trade Center, St. Louis. Thanks for joining us today for this highly anticipated discussion. I think you'll find that our speaker, who is a self-professed numbers nerd, will do a good job of separating hype from reality when it comes to global economic issues. And in particular, as the title suggests, when it comes to tariffs, taxes, and their impact upon global trade. We thank our longtime World Trade Center member company, Commerce Bank, for lending us Mr. Magai and his expertise today. And judging by the number of attendees, we had over 100 attendees register. So I know I'm not the only one who's really looking forward to today's presentation. So just a few housekeeping rules to let you know about. All participants will be muted for the duration of the presentation. However, if you wish to ask questions, and there will be time at the end for questions and answers, you can use the Q&A button at the bottom of your screen. And we will do our best to get to those questions at the end of the presentation. And then, of course, the slides and a recording of the presentation will be sent out to all registrants a few days after this webinar is completed. So now it's my great pleasure to introduce to you the Deputy Director of the World Trade Center St. Louis and my boss, Stella Sheehan. Stella has been with the World Trade Center for over 18 years, and she leads the trade team consisting of myself and Annie Mbale, who's our webmaster today. Shout out to you, Annie. Stella also heads up our Executive Certificate in International Trade, which is our online export training. She oversees our 16 sister cities and is the executive producer of our signature event, Growing Global. Born and raised in Ireland, Stella has lived, worked, and studied extensively in international markets, including Belgium, France, Italy, and the UK. She holds a BA in French and Italian from the National University of Ireland in Galway, and an MA in Applied Languages for Business from the University of Ulster at Coleraine in Northern Ireland. And she's a graduate of Leadership St. Louis and serves on the Missouri District Export Council as well. And as I always say, she's the wind beneath the wings of our Executive Director, Tim Nowak, who is in the audience today. Shout out to you, Tim, as well. Stella will give a brief overview of World Trade Center's work and introduce our speaker. So over to you, Stella.
Thank you so much, Susan, for that very gracious introduction. And thanks to all of you for joining us for, as Susan said, this very timely discussion on a new era in trade. I, along with everyone else, are hoping our speaker has a crystal ball at the ready, so no pressure, Matthew. As Susan mentioned, I lead the trade side of the house, and we like to say that the World Trade Center has three main pillars: people, trade, and investment, the three key equal ingredients which go into making a global city. The people side consists of our 16 sister cities and perhaps our most well-known initiative, the St. Louis Mosaic Project, headed up by my colleague Betsy Cohen, which is an initiative to attract foreign-born to the region and assist them by way of programming and networking once they get here. The trade side, of course, provides companies with the tools they need to trade internationally by way of counseling, referrals to our federal and state partners, and organizing educational events like the one you're attending today. Last but certainly not least, our foreign direct investment, or FDI pillar, led by my colleague Sean Mullins, assists companies around the globe who may be interested in setting up their North American base here in the region, while simultaneously assisting foreign companies who've already chosen St. Louis and wish to expand and continue to invest here. And now to our much anticipated and esteemed speaker, Mr. Matthew Magai. Matthew is a senior VP of the Capital Markets Group at Commerce Bank in Kansas City. The group helps clients achieve liquidity and competitive yields with skillful analysis and strong cash management products. They assist corporations, financial institutions, money managers, not-for-profits, insurance companies, and municipalities. Prior to joining Commerce in 2016, Mr. Magai was corporate treasurer at a $1.2 billion publicly traded community bank in Missouri, where he developed and implemented balance sheet strategies to maximize margin while managing interest rate risk, liquidity, and capital. In previous roles, he honed his treasury analysis skills by providing tactical and strategic solutions to internal and external clients at First National Bank of Omaha, one of the largest privately held banks in the country. Mr. Magai is registered as a municipal securities representative and government securities representative with the Board of Governors of the Federal Reserve System. He's also an instructor of managerial finance and investment analysis and practice at the University of Central Missouri. He has a Bachelor's of Business Administration from Baker University and an MBA with an emphasis in management from Rockhurst University. Over to you, Matthew.
Thank you so much. What an introduction and a lot to live up to. So I will do my best. Thank you so much for having me. It is an honor to be here, and it is an honor to speak with each one of you today. While I may not hold a crystal ball, I'll see what I can do. And as Susan elaborated, the overall message here is that we're going to be okay. We're going to be just fine. There's a lot of words out there. There's a lot of fear. There's a lot of noise that we have to live through every day. Hopefully after today, we'll feel a little bit more comfortable. I too have to have a little disclosure. Basically, this is not the Matthew Magai clause that Commerce Bank has, but today it is. The opinions that I express today are just mine. They do not necessarily reflect Commerce Bank or any affiliate. Everything that I use in these slides today, I'm deeming reliable, although I can't guarantee that. And finally, I am not a tax professional. I'm going to talk about taxes, but please refer to your tax advisor to help with specific questions on that. All right. So what's the story? What are we going to be talking about today? Well, first we're going to take a look at what's the outlook for the global economies, key regions throughout the world, and then a look internally at the U.S. Tariffs. That's going to be the predominant part of this discussion, with key reasons. But let's go ahead and set this stage here. We believe that tariffs are used as a negotiating tactic, and they're usually tied to another key policy initiative of the current administration. So we'll talk about that in more detail here. Then we'll move on to, of course, for my entire life and for most of yours, American citizens have been concerned about the debt level of the U.S. We'll take a little closer look at that, but more importantly, what's going to happen with the Tax Cuts and Jobs Act? Is that going to be renewed, expanded, made permanent, replaced with something different? We'll check the crystal ball and we'll see. And then finally, I do spend some of my time in education. So I want to make sure that I provide you with some sources where you can track this progress on tariffs, progress on taxes, the overall economic performance of the world and the U.S. So let's get started. Two key measurements on how the health of an economy is behaving. GDP, gross domestic product, that essentially is how are goods and services translated in an economy. And what we measure is the change from a prior period. So all these numbers here, I know some of you are going, great, he is a numbers nerd. They're right here. We're not going to go through each one. We're going to look for trends. And so what we look for is a change from the prior year. So for instance, Africa, the Asia Pacific region, European Union, and Latin America are all expected to expand. So that change, that percentage change, is higher than the prior year. North America looks to be coming down a little bit, kind of evening out. We'll talk about the US here in a little bit. But overall, the global outlook for the surveyed economists that contribute to Bloomberg expect that while it would be lower this year, a 3% growth over last year, it's still growth. It's positive. And it's about where we should be, where we normally act, where the world normally falls there in that metric. The other metric that we look at, the measure, is inflation. And inflation is simply price stability. So what things cost. Guess what? They're going to cost more. They always do. Almost always. But we measure on how much more is it going to cost. We had some very inflationary contributions, not only internally at the US, but globally. In the Latin American region, the largest input was the Argentinian inflationary crisis. So that has looked to stabilize a little bit. The region looks a lot better. Prices going up by 10% versus 30, almost 35 last year. The only one that's kind of moderating is the Asia Pacific region, kind of maintaining the status quo there, about 2%. But globally, we're looking at prices increasing on average about 3.5% there, that 3.6%. So keep that in mind. GDP is going to be what we're going to be comparing things, particularly when it comes to tariffs and the impact of that and tax revenues. GDP, if for those of you that have taken your managerial finance classes or just love finance, you know, when you evaluate an income statement, you compare everything to gross revenues or gross sales. This is the gross sales of a company, of a country. So that's what we'll be comparing to. Internally, our chief economist here at Commerce has provided some information for me, which was nice. We don't always have the same projections, but we are close enough for me to use this slide. So here it is. And it's comparing our outlook for 2025 pre-election and post-election. Well, pre-election was before November. Makes sense, doesn't it? Well, GDP growth at that time was supposed to be a little bit softer. We were thinking about 2%. To put it in perspective, the US for the last 25 years grows about a 2% average. So every year, that's the average. So where we're supposed to be, nothing, you know, the Goldilocks scenario, we're not running too hot, we're not running too cold, just right. After the election, the expectation is a more pro-business administration, less regulations, maybe less taxes. So the productivity of the US is supposed to expand a little bit. That's the anticipation, not by much, but we're expanding our range there a little bit. Core CPI. CPI is Consumer Price Index. That's an inflation measure. And core means we simply remove energy and food. Those things we need and those things that are very volatile. So we just remove those. The expectation is that before election was it would fall much lower. Inflation would be closer to the Federal Reserve's target for the US is 2%. That's where we want to operate. We've been above that for last couple of years. Currently, it's about 3.2%. So the current expectation is that it's still falling, but it's going to be closer to 3% than we earlier anticipated. Employment growth, moderate. nothing terrible, nothing, just kind of steady as she goes. Unemployment, steady, 4.2. Since I was in a young student, 4% is kind of the goal. That's just the average. And so that's again, nothing to be too concerned about. The deficit rising, and we'll talk about contributions to that. And interest rates kind of higher than we originally expected. And that's due to some inflationary pressures that might occur here. All right. Trade and tariffs. Here we go. This is why we're here. To look at the balance of goods and services, the U.S. is primarily, majority we are a service economy. That's what most of our exports are. They're going to be service oriented, and we buy lots of goods. We still make goods here. We still sell goods, but the majority of our economy and the exports are in the service category. So if we combine those, we've had a deficit. And what does that mean? That means that we import more than we export. We are a consumer-driven economy. That makes sense. That makes sense. We like to buy things, and we like to buy things from around the world. Just see the trailing 3-month average here is we're right about there, but you can see the trend that it has, this deficit has been expanding. We've been importing more, exporting less from a dollar's perspective. This was the slide, may be a little difficult to read, so I highlighted the key points. And this is, again, the point of, we're going to look at this 2 ways. The first way is, why are we talking about imposing higher tariffs on China, Mexico, and the European Union? That's more politically driven, right? Well, as I mentioned earlier, they're used as a negotiating tactic to get to the table, to start the discussions. During the campaign trail, President Trump was talking about a 60% tariff on China. Now it is a 10%. So discussions have started. Over the past weekend, we saw, related to immigration policy, Colombia was threatened with a 25% tariff for not accepting the deported immigrants. After negotiations, no tariff so far. So again, when we see the headlines and we read the initial stories, it sounds like a big impact to our businesses, potential impact. With Mexico, that's going to be immigration driven. Same with Canada. With the EU, it's going to be driven by the Trump administration's desire to sell more petroleum and natural gas, to expand our exports to them. And remember, the big European Union effect on natural gas when the Russian and Ukraine conflict war started. That's where they were getting the majority of their natural gas. We're trying to help, as a country, help ourselves by helping them, by providing them more energy. And China, another alternative contribution to that threat of higher taxes is going to be, we need your help with the Russia and Ukraine conflict. Help us resolve that. Now, the other way we're going to look at this is from a purely business perspective. We do this internally, and I'm sure you do this at your organizations. You look and say, you evaluate what your customers are getting from you and what they're paying you. And if I'm a business professional and I see a chart like this of my customers, and I say, okay, China, Mexico, European Union is getting more from us than we're getting from them. That could be a driver. I'm not saying it is, but I understand that mentality. That's something I could relate to. We'll see what happens. Our top trading partners, this is year-to-date compilation entered by our trust department. You can see we're measuring it as a percentage of GDP, or that total productivity of a country. And this is the US. So with Mexico, our imports represent about 2%. It doesn't seem like a lot, right? It's a lot of dollars, but it doesn't seem like a large amount of our productivity. China, about 2% imports. Canada, 178. You can see the trends here. What the key takeaway is our total imports make up about 14% of our GDP or productivity, and exports are about 11%. So combined, about a quarter. To put it in perspective, the US consumer makes up about 70% of our gross domestic product. So you can see that our purchasing power and our purchasing behavior really drive our economy, which is why we import a lot of goods. Over time, over the last several years here, we've seen some ebbs and flows, of course, obviously affected by the global pandemic there on the left. When things went down, we imported less, we exported less. But the average difference is about 3.2% between our imports and our exports as a percentage of GDP. And again, you can see that total 14 and 11. This is the way our economy has operated for a long time. Economics is called the dismal science for several reasons. But one of them is we're trying to figure out how to make do with limited resources, right? And so when you have limited resources, you look to partners across the world to help with that. And that's what imports are. Highlighting a little bit about the European Union trade. This is a great graph I saw on Bloomberg the other day. It puts it in perspective. This is the oil and gas that we send to the European Union, trade with them. We get paid, don't worry. And that represents kind of this lower area here. This is the effect of our trade deficit with the European Union. This is all the goods we buy. I have a European car. I have European furniture. It's IKEA, still European. I have European clothes, European foods, wine. You better believe we have cheese. Oh, we love cheese in this house. We buy European goods all the time. They're a great import partner with us. But again, from that business perspective, you can see that they are getting more from us than we are getting from them. So that could drive that desire to charge a 25% tariff on their imported goods. This is some custom duty. So what has been collected or paid by U.S. importers to the government in billions. The expectation, the estimate is that for last year, it'll be almost as close to the highest peak that we saw in 2022. But that's just to put in perspective, $80 billion. That's a lot of dollars that is being collected. And we'll talk on the next slide here what that from an average tariff rate. So we talked about dollars, but what does that percentage mean? When we talk about when we hear we're going to implement a 25% tariff on Mexico and Canada or the EU, what is that? What impact does that have on our actual current tariff rate? You can see the highs were back in 1933, Great Depression. Makes sense. Coming off World War I, going into World War II, comes down. We've basically been going down for the most part, and our average is about 2.5%. That's the effective tariff rate on everything we import. Doesn't sound like much, but it's a lot of dollars. But if the current Trump proposals of these 25% tariff on Mexico and Canada were implemented and a 10% on China, that would increase that average rate to 12%. So you can see the impact. That's a huge impact from where we are to where we could be. Do we think this is going to happen? No, I don't. I don't think we're going to get that high. But just because I don't think it doesn't mean we don't need to plan for it. And that's where a thing in my world is scenario analysis. So you essentially pick some options and you plan for those and you quantify the effect on your business. So you could say, what do we look like if these things do happen? What if my major trade partner that I work with is Mexico or the European Union or Canada, and that 25% tariff is implemented? How does that affect my gross revenues and my net income? And what do we look like if that happens? How do my costs rise? Then I'll look and say, okay, well, what if things just stay the same? That's another scenario, or close to it. What do we look like? What do we budget for? And then what if things are in between? What if we only have that 10% tariff instead of the 25? What do we look like then? That's scenario analysis. So that's a good practice to have. Many business operators do that. Students are going to know this because they have to do it for homework. It is something that is used in the real world. It helps us plan. Worst case, best case, what we think is going to happen. Those are great ways to kind of take the headlines and dig a little deeper and say, okay, well, how does this really affect me? So it's a good practice to get into if you're not currently doing that. It also helps your fellow board of directors or your managers feel a little bit at ease that you're planning for it, just in case. But by and large, I do think this is a negotiating tactic tied to another key policy initiative. I do not expect that we will see that big jump in our tariff. I do think we will have tariffs increases, but I don't think it'll be 12%. Okay, so what about the US debt and taxes? Again, I'm not a tax advisor. Some of you on here are tax professionals. Bless you. You are well needed and much more knowledgeable when it comes to this, how to react in these tax proposals. But what I'm going to concentrate on here is, again, I mentioned for my entire life, it has been the fear that we have too much debt. Well, a lot of times we like to look at the US government like either a business or a household. And how can they keep operating if they spend more than they earn? One could argue that's the American way. That's why our consumers are so important to us. They use debt when they run out of money to keep buying. The US government is no different. We have, every administration has policies they want to implement. They want to fund those. But one of the key metrics or measures that they use is, how do we do as compared to the GDP? What do we, again, so I said that again, we're going to keep comparing to a percentage of GDP. In the bottom left here, it is higher. It's been higher. Of course, during the global pandemic, we had huge amounts of support from the government. That makes sense. It's come down, but not a lot. We're 100% of what we produce, we spend as a government. So when we talk about increasing revenues, that would be tariffs and taxes, increasing taxes. I have yet to meet a politician that wants to increase taxes. Truly, they may focus on a particular group, but usually the idea is to cut taxes. And if you can remember your Keynesian economics, when times of trouble, you cut taxes and you increase government spending. And up here, you see nominal GDP. Nominal just means numbers, dollars. This is our dollars in GDP. It's been growing. It's been expanding. That's good. That's a healthy economy. We're a mature economy. We don't act like it sometimes. We think historically we're still basically, young professionals. The US has not been a country for that long compared to the rest of the world. However, our economy is strong, and it's at a point where we shouldn't expect 5, 6, 7% growth every year. That's just not, we're not capable of that for several reasons. All of them are policies, immigration, our demographics, our aging population, what we produce and what we sell to the rest of the world. Those are all contributing factors of why we grow at about 2% every year. But these light gray bars are going to be the percentage of deficit spending. So of our GDP, how much are we funding by spending more than we bring in? It's moderated. As I said, during the pandemic, and the government stepped in to support a lot of us. A lot of us received checks in the mail. Businesses received forgivable loans to the SBA. That makes sense. That's that Keynesian economics. We boost those up, boost up the spending. But it's been moderating, and it's expected to increase a little bit as a fiscal year end estimate there for 2024, and likely to increase going forward into 2025. Finally, the other key period here, and this is my world, is interest rates. The key factor is, well, how much is this debt costing us? It's okay to have deficit spending when interest rates were almost zero, right? Cheap funding for everybody. Well, now they're at a more normalized place, 4% range. That's kind of what we historically should be, where savers get a return and lenders get a little return on that loan. But we are reaching a point where, this is the Congressional Budget Office. They tend to project things out for the government. They don't tend to, that's their job. But you can see that is expanding, the cost is expanding. So what do you do? Well, let's talk about the taxes. The current corporate tax rate, 21%, and other personal tax rates affiliated with the Tax Cut and Jobs Act. The thought is that they will be extended, not necessarily lower. And again, I think that's a campaign promise that was put out there about maybe cutting it down to 18%, 16%, something like that. I just don't see that happening. But I do think they're going to be at least extended. I don't know that they're going to be made permanent. So if they're extended, that's that status quo scenario. So if you're planning, you can say, okay, what if things just stay the same? What do we look like from our tax perspective? What if they get cut and we are a corporate and C Corp? How does that affect us? Those are, again, scenario analysis on that. But one key point here is going to be Bloomberg Intelligence is this group that works on Bloomberg that provided an estimate of it would cost $4 trillion worth of cuts that would be needed so that the deficit doesn't expand. That's a lot of money. And finally, that this is another measurement here. So of the revenues that the government brings in through taxes, what percentage of our productivity is that? It averages about 17%. To balance the budget, we need 23.5%. So that's why we're running at a deficit. We're not bringing in enough. And as a business operator, that's when you start thinking, what do we do about it? And that's why we're seeing cuts of programs and cuts of funding being proposed and implemented, because you can't really increase your revenues that quickly, as quick as you can manage costs, unfortunately. I did reach out to my foreign exchange desk in our bank here that have some great people that help our customers in that realm. And key things for them is the adoption of digital currency beyond Bitcoin, right? It's expanding. And the dollar strength is likely to continue. And one little personal measure that I look at the euro and how that, because I love to go to Europe with my family, love to travel there. As you know, I like European goods. I like to go there. I watch the difference between the US dollar and the euro. And right now it's getting pretty close to being paired up 1-to-1. So 1 equals 1. Historically, it trades about one. It takes $1.11 or $1.15 to get €1. The expectation is that it might be close to more 1-to-1 this year. And then finally, how will AI affect us? We can't go a day without thinking about AI and planning for that. How will this affect foreign exchange as far as either internally, how do we help our customers, or some of our more regular duties going to be automated through AI, or are our customers going to find other outlets? That's something to think about. And for you, dealing with foreign currencies in your work, how do your payment systems work? How is that going to work? Is it going to be, I don't know about you, but I receive a call every once in a while and the voice does not exactly sound human. So that puts a little scare in us bankers and finance people. We were concerned about risk management. How are the implementation of more AI functions in our workplaces going to be monitored for fraud and or risk? Some resources, I told you I'd provide you some. So how do we monitor progress on what the magic crystal ball of Matthew Magi said? Well, it's not just me. It's a lot of economists. It's the dismal science, because if you're right 20% of the time, you were a genius. So I'll shoot for the high teens. Either way, the U.S. Department of Treasury is a great resource for several reasons, but one, that's where you can find where Treasury rates are. Makes sense. That's our key interest rates. Federal financial data, what comes in, what comes out. And then this is key. This I mentioned, I talked about it. A lot of us worry about U.S. debt. This USspending.gov tells you how the government spends their money, where it goes. So that's always to be educated in that. A lot of us like to talk about it at parties. Well, know your stuff, USspending.gov. And then there are some international payment systems here, information there. Under the Bureau of Economic Analysis, we've got GDP, consumer spending, income savings, and there is an international trade section here as well. This is where I got some of the data for that chart that was hard to read. You're welcome. There you go. No, great resource for goods and trade and goods and services. Monitor that progress. The U.S. Bureau of Labor Statistics, good stuff on the labor. That's the important part, but also inflation. You can monitor the consumer price index, what we're making there. U.S. Census Bureau has an international trade section. They also have good demographic, obviously, that's their purpose, but some more international trade, guide to international trade, that kind of thing. So good. And the reason I'm using governmental resources is, well, that's where we get our key economic data from. So all those economic releases, they're coming from government sources by and large. Locally, for you St. Louisans, I'm a native St. Louisan, so I go here a lot. It's the Federal Reserve Economic Data section of the Federal Reserve Bank of St. Louis. It's a branch of St. Louis. We have one here in Kansas City. Missouri is the only state that has 2 Federal Reserve branches. They do have, what I use Fred for a lot is to build charts for presentations or check on key economic data. So they bring all that. And they do have an international section. You can look at over 120,000 countries, 120 geographies, 85,000 indicators. Have at it. It is so fun for nerds like me, but it can be fun for you too. Great resource. And the economists at the Federal Reserve in St. Louis are fantastic as well. Finally, some other resources here. And as I tell my students and I tell myself is, don't just use one source. You can go to Bloomberg. I'm on Bloomberg terminal all day. That's unfortunately, you can get locked into saying, okay, that's my news source because I have to use it for work. But go to Fox Business, go to CNBC, go to NPR, whatever you want to go to, just use multiple sources so you can kind of get the full story or a better picture of the story. Your World Trade Center here in St. Louis is a great outlet. The U.S. International Trade Commission is another governmental site, great information on trade. IRS, for those tax professionals, they know it well. For the rest of us, guess what? 401k comes from there. There we go. 501. So it's all there. And then finally, your favorite economist. No, this isn't me. This is who do you follow? I follow David Kelly at JP Morgan Chase. I think he's fantastic. Mohammed Al-Arian. He was formerly with PIMCO. He is president at Cambridge University in the business area. He's frequently on Bloomberg, CNBC, Financial Times, Wall Street Journal. He's a Jets fan. I don't know why, but he is. No, he used to live there. He is English. Great resources out there. There's plenty of them. But remember, have a little pity for your local economists. We do the best we can with what we get, and we enjoy getting in the data, but more importantly, what's the story? So the story is we have a lot of concerns about tariffs, how they're going to affect our businesses. They're a negotiating tactic in our eyes. We may see some increases in tariffs that would help with increase those revenues we need to help monitor our deficit. But it's really associated with a um, total relationship and total diplomatic effort for that additional policy, whether it's immigration, whether it's energy. It's all, there is some logic there. Sometimes it doesn't seem like it's there, but if you put on your business hat, you can kind of see from a financial perspective, it makes sense. But the US government is not a business, it's a government of people. So we'll just keep an eye on that. But by and large, trade should happen. It always happens. It should be healthy, growing. At our countries should perform at usual levels, which I know usual can be boring, but to an economist, that's great. That means status quo. We like that. We like that. So just keep an eye out for that. And then as far as the taxes go, I think the Tax Cuts and Jobs Act will be extended. I do not expect the corporate tax rate to decrease or increase for that. So status quo on that. Final thing, if everything's getting you worried, you're getting stressed out, you do too much, right here. I have a hard time saying no, but I love doing all the things I do. And the way I get through it is doing something nice for somebody. So I found this quote the other day. So a friend of mine had it, and I love it. Goodness is the only investment that never fails. If we are good to each other, we can handle anything. It improves other people's lives. It improves our lives. It makes doing what we do worth it. I'll let you determine what good is, but just enjoy life, enjoy it. Appreciate everything you do, and thank you so much for allowing me to be here today.
That is great. Thank you very much, Matthew. It's really like the pace that you took as you went through this. You knew that there were some students in the audience, and I'm not an economist or finance person, so it was really helpful for me to hear the way you described these things. Not surprisingly, we are getting some good questions in the chat. Let me just take a look here. I gotta squint a little, folks. Hold on a second. Well, so one person is concerned about, he or she appreciated the list of government sources, as do I, because I've got some other ones that I go to regularly, but I didn't realize all this great information was going to be on these sources. But with government, potentially Trump putting some other people in office, I guess he's in those roles, just wondering, how you feel, how reliable are those resources going to continue? Anything in your crystal ball about that?
Sure. No, here's a trend I've noticed. If we don't like the numbers, we find them suspect. And that's something that a lot of us, all of us, are guilty of. I am not so much concerned with if key positions are not filled, or we have less people doing more. I've done that my whole career, but you know what? I showed up. I still show up, and I think the people that work for the government show up. The people that do the work are going to do it no matter who's in charge, and that's why I think it's reliable. A good question.
Okay. Yeah, and I think maybe this is for Annie. Somebody was saying that the Fred link doesn't work, so I don't know if that was typed in properly, but just a reminder that this presentation will be sent out afterwards, so everybody will get the links that are on the slides as well. We've also got a question from one of our Canadian listeners, I think probably at the World Trade Center in Canada, and don't know if this is within your purview, but are there any tips that you could give to Canadian businesses to navigate those new tariffs if they get implemented?
I wish I had the clear answer. Let me just show you this real quick. This is just kind of an example when I talk about the scenario analysis.
Okay.
You can change this to Canada or wherever you operate. And essentially, as I said, what if the tariffs on us are 25%? what if they're 10%? And what if they're kind of a status quo, or put in whatever that is? Find out the economic impact to you, and then you assign a weight. And that's essentially, what's the probability, I think, of this happening? The secret is it's got to add up to 100 between your scenarios. And what this does is it says, okay, well, the weighted average, given the probabilities that I've assigned, that there's a 20% chance of a 25% tariff. Don't you love percentages? Anyway, 50% chance of it happening, a 10% tariff, and a 30. You can change these. You can change these. And they all populate and say, okay, the weighted average effect is probably a little less than 11% tariff. Well, if I think this is wrong, I lower that and I increase that. Well, 10%. So it's a way to, this is very simplistic. Believe me, yours is going to be more complicated because you know more information. But my point is that you can do a scenario scenario analysis to help you kind of get a little more comfortable with the effect of that. Now, as far as sources, that's a little out of my purpose.
Yeah. Okay. Well, appreciate giving that a good shot. I had a couple of just, I guess, kind of smaller questions, but as you were going through the slides, I was trying not to jump in and ask. But the one is on sort of how GDP works. You've got, I think I wrote down that US consumption is about 75% of the economy. Trade is about 25% of the economy, but that's not, you don't add those together and make 100%.
Right. No. And in fact, the imports are kind of a imports minus exports. So it's really about 3% contribution. You also have government spending, and you have private investment. Private investment is the business spending, business investment in the companies and that kind of thing. So all those things, yeah. Consumers are about 70%. So that's why our central bank is tasked with price stability, which is inflation, and interest rates. They use that to manage that, and maximum employment. We're the only central bank that I'm aware of has that dual mandate. Most central banks, like the Federal Reserve in other countries, the central banks in other countries, are just concerned with inflation, managing inflation.
Well, that's a good thing to know as well. We occasionally get to hear from Chuck Gaskin, who's at the St. Louis Federal Reserve, and he's always got great information. So
he's good. He is very good.
Yeah. The other sort of small question I guess I had, you were talking about the tariffs, and like for China, for instance, are you, like there currently are tariffs on China, that 10% you talked about, would that be on top of that? Is that what he's talking about doing?
I think he's talking about raising it to that level.
Okay.
So it wouldn't be like
Raising
a
it by
10% increase. Yeah, it would be a total would be a 10%. Yeah.
Got it. Okay. And then we had some speakers on right after the election, kind of looking at trade and some of these things. And I know one of the things that confuses me is that the North American Free Trade Agreement is up for renegotiation or renewal in 2026. And right now, so that means that there's no tariffs between Mexico, Canada, and the US if the items are created, made in those three countries. And I'm kind of scratching my head about, how can he then slap tariffs on top of that? But that's probably a trade question, not necessarily a question for you as a banker. Do you have a shot at that one?
This is going back to the first disclaimer. This is Matt's opinion. And I think we've seen that this administration is not afraid of pulling out of agreements, right? And I think that's another negotiating tactic. It's just extreme option to get to a compromise,
right?
But then make that compromise like it was our idea in the first place. That's every goal of every negotiator is like, oh, that's what we wanted in the beginning. Right. I think there's probably we have a good chance of having some tariffs imposed on our neighbors. I hope we can get back to that NAFTA-like agreement and renew that. But there may be some rough waters in between.
Okay, well, thank you. For any of you who are interested in hearing about that particular Engage in Trade, it was on November 12th, I believe, of 2024. You can go to our World Trade Center St. Louis YouTube channel and you will find it there. And that, by the way, is also where this will be uploaded once we have completed everything. Are there any other questions? I believe I've asked all of the open questions that are in the Q&A, and I appreciate, Matthew, that you gave us some time for those questions. We're going to put up a couple slides in a minute for our upcoming events, but last call for any other questions that people might have. It's tough when you have to type the answer, and I don't see anything that says somebody's typing, so I'm going to give it just a minute. And then Annie is putting up the slides. Okay. Well, let's just get to these upcoming events then. Thank you, Matthew, very much for your presentation. We really, really appreciate it. And it's going to be great to have that list of resources up there available. I'll probably be referring people to it for a lot of times in the future here. But our upcoming events, this is a monthly speaker series and we cover all sorts of topics. I'm very excited about the next one coming up in February because it's a topic we have not touched on in quite some time, but it's very important. So safeguarding your intellectual property when selling abroad. We are going to be having another World Trade Center member company, the law firm of Brian Cave, Leighton Paisner. One of their experts on intellectual property will be presenting that. That's going to be Tuesday, February 12th from 10 to 11. It's a webinar. And then one of our favorite events of the year is International Women's Day, which is coming up the first week of March. We will have that event in person. Actually, probably I've got 12 to 1 up here. Probably we'll have it from 11:30 to 1, but it's going to be here at our World Trade Center offices in Clayton. And we are in the process of putting together an excellent panel of international women, foreign-born women who are living in the St. Louis region and have some interesting stories to tell us, some inspiring stories to tell us, and also we will be touching on this year's theme, which is Accelerate Action on women's equality. So those are our upcoming events. And at the end of this webinar, everybody who registered everybody who's attending, I suppose, will be receiving a survey evaluating the webinar that we just concluded, and we would very much appreciate your feedback. And there's also an opportunity there to give us some topics that you would like to see us cover in future webinars or in future face-to-face events. Now that hopefully the weather's going to get warmer soon and we're going to have more events in person. But we appreciate everybody's participation today and look forward to seeing you soon at another World Trade Center event. Everybody have a great day, and thanks once again, Matthew.
Thank you. Have a great day.
Yeah, this concludes our webinar.